Welcome to our weekly market review with myself, Ilze-Marie. I'm with ETM Analytics. Today, I'm joined by Wichard Cilliers. He is the head of market risk at TreasuryONE. So, Wichard, just a quick look back at last week. We saw the US PCE core deflator coming out, and now it is an important data set. It's the Fed's preferred gauge of what's happening with inflation in the US. And, you know, it was in line with expectations. We saw the increase month on month in January, but what we also need to point out here is that when we look at the year-on-year data, there's still a very much disinflationary trend. That's still very much intact. But the month-on-month increase, that may just point out exactly how sticky inflation is. I think I said it previously as well.
Yeah, thanks, Ilze-Marie. Yeah, so the inflation number came out, like I said, in line, 2.4% for the PCE deflator. It's still above the 2% target that Jerome Powell really wants. The month-on-month figure came out at 0.4%. And if you analyze that 0.4%, that means inflation is going to start to tick up again and go back to the 4% mark. So it's definitely that higher rates for longer narrative that Jerome Powell has been talking about that's going to stay with us. The trend, if you can look at the graph, is downwards, but it's sort of bottoming out at the current level. So it's something that we really need to watch going forward, and something that Jerome Powell and the Fed committee will also definitely watch.
Yes, everyone is waiting for inflation to finally break that 2% or at least get below the 2% target. And the thing is, the Fed is not getting much help from the US stock market at the moment. You know, we've seen a massive rally with the stocks in recent weeks, basically largely due to the surge in tech stocks, with the AI, taking the trend there, but they're also receiving some support through the loose financial conditions that we're seeing, as the slide that you have up with the US Financial Conditions Index.
Yeah, so they've always been speaking about the trying to tighten things up, but with the budget deficits and the debt that the government's running up, if you look at the US debt, it's almost at 35 trillion. So they continues to print money, running up their budget deficit. And with that budget deficit that they're running up at the moment, it means looser financial conditions. So all that money that they're effectively putting into the market needs to find a home. And we can definitely see the US equity markets is ramping up. All new time highs, week in, week out, 4-month rally. But if you read the markets, and we'll come to the slide later on as well, we're going to see if that labor data is Google is laying off people, the Amazon's laying off people. Across the board, you're reading people are laying off people. So there's a massive disconnect in what's happening in equity markets and what's happening in the real economy. And that you can see by this, you lose financial conditions in the US.
Do we expect the cycle to turn at one point? Do we expect the conditions to start showing the cracks? I mean, how many months more do we have to wait for these cracks to show up in the stock and equity markets?
So if you go speak to one of your own analysts, Mr. Glynos at ETM, he'll tell you that if you look at the housing markets, if you look at labor data, all of those things are already starting to show cracks. The yield curve has been inverted for a while. It sort of disappeared. So the cracks are there. It's just for the water seeping through. It's when the dam bursts. That can be another 3 months, 6 months, 9 months. Nobody knows exactly, but the cracks definitely are showing from that perspective.
And like I said, we'll get to the labor data in a moment because there are several data releases coming up this week, and a lot of them with marketing moving potential. South Africa will see the release of the GDP figures for Q4 last year. And expectations show that, we may have dodged a recession, which quite frankly is not anything to brag about because the economy is basically almost at a standstill at the moment. Also coming up is the ECB. They will give an update on their expectations going forward.
Yeah, so ECB will be in the same narrative what Jerome Powell and the US Fed is they're going to watch inflation. The numbers are going down. If you look at Germany and France came out inflation numbers last week, it's down, but it's still within the target range. So Christine Lagarde, the ECB president, will definitely just say, we are continuing to look at the inflation data. We'll monitor it, and they're definitely not going to cut this week. But the narrative that comes out from the ECB will be important to watch, to see, and to gauge when they're expecting to cut rates. Are they going to be in front of the US? Are they going to be behind the US? That all plays a critical part in what happens in the currency markets, what happens in the general economy going forward. So the narrative afterwards and the speech afterwards will be more important than the interest rate decision from our perspective.
We had a quick look at the FRA curve actually just before I walked in. One of the analysts are working on a report, and it actually shows that the first rate cut for the ECB is expected as soon as July. I say soon because somehow to me that still feels too early for them to really make a move, but who knows? We will have to wait and see what they say this week. Also, and this is the big one that everyone will be taking a look at, is the string of labor data out of the US. We have the job openings, the ADP employment change coming out on Wednesday, but the big one, obviously, the non-farm payrolls. That will be out on Friday. And we spoke about this now earlier, but a lot has been said about the robustness of the US labor market. How is this keeping up? How are they doing this in the tight monetary conditions that is in the US at the moment? The thing is, when we take a deeper look at the data, the picture changes a bit of color. Everything is not as solid as it may seem on the surface.
Yeah, so everybody always looks at the headline number, how much jobs have been created, and it's been positive month after month after month for continuous kind of period. There was a miss figure in November last year, and it was the first miss in US non-farm payrolls in like 16 months. And then afterwards, they've been shooting the lights out. And again, if you look at the number, the headline number reads something, but the hours work are less. The jobs that created are not permanent jobs, it's more temporary jobs. The wages are not going up as far. So although the headline number looks rosy, if you, like you said, if you delve deeper into the things, is number of hours works are later, the income is lower, the wages are lower. So all those things is actually hampering the employment data. And that's one of the cracks also that starts showing is the headline number looks rosy, but if you dissect it, it's not as great.
Yeah, you kind of come to the conclusion that the quality of the labor is declining. It's not that those robust permanent positions, and the quality of labor is where it's showing up.
Yeah, and it all ties in if you go read the headlines from all the listed companies out of the S&P 500 and the Nasdaq. Most of them are laying off people. So now you're asking is how do you get this number on non-farm payrolls being up month after month, but you're just reading about layoffs? There's a massive disconnect. And again, that's about people that actually goes and finds a second job or a third job to keep the boat afloat, because inflation that's up there and interest rates that's sky is definitely eating into the average economy, average consumer in the American economy. So they're struggling to pay their rent, they're struggling to pay their housing mortgages. Second-hand car sales are down because people are struggling to pay cars. So it's definitely the labor data isn't as rosy as it should be. And it's a very important number to see, because that will determine again are the Fed going to start cutting in June, July like the ECB, or are they going to push it out further, or they're going to bring it closer? So this data is very important to conform to see what happens with the interest rate market.
Feels like it's anyone's guess at this point in time. So there's a lot happening this week, a lot of the data sets with a lot of market moving potential. So possibly a bumpy ride for the Rand coming up this week. Nothing much that I can notice that will provide some support for the currency to break this ongoing declining trend that we've seen over the past 2 years.
Yeah, so I'll go back to the first slide. So it's a little bit dark, but yeah, at the bottom you'll see that Rand is one of the worst performing emerging markets. I haven't put up Turkey and Russia because they're the only ones that's worse performing than us. But South Africa is a lagging emerging market at this stage, and that's because of our own goals. And we can go into debates about our own goals in electricity and water and infrastructure and the government. And we've gone on length about what happens in the budget speech and how it was preserved. But just to summarize, the Rand is still an underperforming emerging market. And again, we saw it broke out of we've got like an 1820 to 1920 range on the currency at this stage. We broke out briefly last week on the 1930s. We're now back sort of at 1902 at the moment this morning. So we're still happy from that perspective that the Rand is still in the 18 to 1920 range. Obviously, this week, there's a lot of data that can change that. Especially the US data on Friday afternoons that comes out late. If that number is a bumper crop number again and it shows the US exceptionalism again, maybe we go to the top of the range 1920, 1930s again. But if that shows and there's a points on the bottom side, then the Rand can go back to 1880. But from a longer term perspective, we just reiterate the rand is undervalued. There for exporters, there is value in the currency. And if the US and the budget deficits and all starts to crumble, we'll probably see the dollar under pressure and the rand come back, but not because South Africa does anything spectacular, just because the dollar will be under pressure.
For South Africa. Wichard, thank you very much for your time. We will definitely check in again next week.